Good day, grade 12 learners. Welcome to today's accounting lesson. My name is Paddington Zinzombe. This lesson is being brought to you by the Gauteng Department of Education in collaboration with Saibono Discovery Center. Let's take note that last week we had a lesson on budgeting. Today we are bringing to you a lesson we are naming Budgeting Part 2. So we are still continuing with our budgets. Let's just look into other situations. Now, please check what we covered in our previous lesson. We went into looking into the different types of budgets, and then we looked into how to prepare a debtors collection schedule. We also looked into how to prepare a creditors payment schedule. And then lastly, we tried to complete a cash budget where some missing figures are given. Now, today, we are still going to look into the same concepts, but we are going to try to look into the completion of a debtors collection schedule again, very important part whenever we are preparing our budgets. And then we are also going to complete and analyze and interpret cash budgets. We are going to bring in something a little bit new, the completion and analysis and interpretation of a projected income statement, part of the budgeting process. And then we are going to look into questions that do a little bit of analysis and interpretation of budgeted information. Now, problem solving on budgeted figures is also going to be part of what we are going to look into today. Now, let's bring back the format of the cash budget as we did last week. Please remember what I said. Very important. Two important parts: receipts and then payments. Now, we are going to have total receipts and then we are going to have total payments. And please take note, we are going to now have to say receipts less payments to find if there is any surplus. If there is any surplus cash, we check what can we use the surplus cash for. Or there is going to be a deficit. If there is a deficit, then what or where can we get some additional funds? Please take note, this is an interactive session. We expect you to be sending your comments or asking questions on 064 748 8913. 064 748 8913. Now, please take note of this. After having our debtors collection schedule, we transfer the figure from the debtors collections. It is the one that goes to be receipts from debtors. Very important. So whatever figures we are having from our debtors collection schedule goes into our cash budget as our receipts from debtors. And then all the figures that we are going to get from the creditors payment schedule, we are going to transfer them into our cash budget as payments to creditors. That's payments to creditors. And please take note, these are very important parts of our cash budget, which means we need to go and look into those figures, and then after having our solutions, brings these to the cash budget. Now, let's have an activity in which we can be in a position to see if we can deal with information as required in the cash budget. Activity 1, we have got Shepton's Traders sell household appliances for cash and on credit. They also charge fees for repairing appliances, but only for cash. The business owner is Brian Jones. Please take note, whenever you are given information that is given at the start of the question, go through that information. Try to internalize it because there is significance the type of business, the types of activities that the owner is up to. Very important when you get into some more information into the question. Now, the information relates to the budgeted period of November to January. So we are looking into November, December, and January as the best, as the period that we are looking into. What are we required to do? The first thing, to calculate amounts indicated by A to C on the data's collection schedule provided on the answer sheet. And then we are expected to calculate the amounts indicated by A to C on the cash budget provided in information F. Now, what it therefore means is we are going to be using information that is provided to us in order for us to deduce the figures that are given. What I did when it comes to the data's collection schedule is, though there is only A, B, and C that is missing, I am going to try and give you an overall way in which we are looking into the data's collection schedule, so that at least you can see how do we go about. And so we are going to be calculating even some of the figures that are already given there. There is the information that we are given. Check what are they doing here. They are giving us sales, and they are giving us cost of sales. And check, they are giving us from September, October, November, December, and January. Though we are having a cash budget or a data's collection schedule that is only starting in November, December, and January. So we are given more months. Why? Because when it comes to collection, in November, we are still collecting money from debtors that bought goods in September. So we need to know how much was in September. And please take note also, there is always a direct relationship between our sales and our cost of sales, because our cost of sales represents our purchases. Very important for you to note. Now, they also gave us information B to say is credit sales. 40% of the total sales are on credit. Remember, when you are preparing a data's collection schedule, you can never be able to do it without credit sales figures. So here, what we are given are total sales figures, which we are not interested in per se, but we are interested in credit sales when it comes to the data's collection schedule. But at the same time, though we are interested in credit sales for the data's collection schedule, we are also interested in cash sales. So if they are saying credit sales amounts to 40%, they're not saying it, but we already know cash sales amounts to 60%. Very important. You must be in a position to know that. Now, let's check the additional information given. We say whenever we are dealing with collection from debtors, history comes to play. From history, from what we have been doing in previous years, how have we been collecting from our debtors? Is there a uniform way in which we have been collecting, so that we can apply it and expect to say, okay, if 20% of our debtors have been paying us in the month of sale, then let's hope that's what's coming as we go. So the first thing that they're saying is 30% paid in the month of sale, and we always gave them a discount of 5%. So we expect 30% to pay in the month of sale so that they can get a discount of 5%. 45% paid in the month following month of sale. No discount on that one. So it means these ones, if they are buying in January, they are paying in February, 30 days later, a month later. And then we have got 22% that are paying in the second month. So it means if they buy in January, they skip February, they pay us in March, the 22%. So this is the trend that we have discovered. 30% in the month of sale, 45% in the month following, and 22% in the month. Now, if you can add those percentages, 30, plus 45, that's 75, plus 22, that's 97. It means there is a missing 3% there. Please take note of that. And they are saying here, bad debts are taken into account in the third month. So they are simply saying here, after collecting 3%, you can see how I got 3%, right? Adding all the percentages, adding up to 97%, but we need 100% in total, right? So the 3%, the missing 3%, is the one that is going to be declared as bad debts. So after 3 months, we are going to say, this amount is never coming to us. Let's write it off as bad debt. Now, let's check now, how do we go about preparing a debtors collection schedule? Now, please take note. The first thing that we need are the credit sales. We need these figures. And from the information that we are given, it's straightforward. Because they are saying here, 40% are credit, and we all agree that 60% becomes cash sales, right? So that is very important information that we are given. And now they are saying here, when it comes to payments, 30%, 45%, 22%. Take that. Very important. And then, what you need to know is, when it comes to collection in the month of December, we are collecting where December and December meet. That's 30%. And then we go up 45%. And then we go up 22%. When it comes to the month of January, please take note. Very important. Where January and January meet, that's where we are going to have our 30%, because 30% in the month of sale. And then we go up 45%. And then we go up 22%. Very important. Now, when you can be in a position to establish this, then everything else is straightforward. So let's start by looking into December. December collection. Remember, we said December collection is going to be 22%. Now, it's 22% of what? We check in that line. So it means what we are collecting as 22% in December, it's collection for the third month. And it has to be 22%. And which month are we collecting from? So we are collecting from October. Very important. So we check what is the credit sale for October, 308,000 times 22% of that. We get our 67,760. And you can see where we are entering that. The collection for December. And then let's also check now, what is going to be the bad debts? Remember, we said bad debts are going to be recorded in January now. Why in January? Because remember, we need 3 months to be in a position to say, oh, these ones are not going to pay us. So we are looking into credit sales of October and finding our 3%. 3% of 308,000, and that's how we are going to get our 13,860. And by the way, this was your A. A was calculating the amount that is going to be recorded as bad debts in our projected income statement. Very important. The percentage was not given. We found it, 3%. And remember, we sell in October. We collect the first in October, second in November, third in December. And then in the 4th month, which is January, if anyone have not yet paid, which is the 3%, we declare them as bad debts. Let's continue now. The next collection, we are now collecting for November. But please remember the order in which we are collecting. 30%, 45%, 22%. Remember the order. 30%, 45%, 22%. Very important, because if you can do that, then life becomes easy. So we are dealing with November. So we now know when it comes to collection in December for November, collection in December for the month of November, we are going to have our 319,200, we multiply by 45%. And you see where the 45% is coming from now. That's the second collection. And then we are getting 143,640. Straightforward. We can also collect in January for November again, and it's going to be 319,200 times 22%, and we get our 70,224. Please remember, there is no discount when it comes to the third collection as well as the second collection. So we are not dealing with discount as of yet. Straightforward, let's move on. We are now going to move on to see how do we go about calculating for the month of December. Now, please take note, very important. This is December, and December 30%, 45%, 22%. When it comes to January, 30%, 45%, and 22%. When you have it like this, life becomes easy. So let's check. We are dealing with December now. But in December, for December, the 30% comes with a 5% discount. So how do we go about it? Let's check. We can calculate in steps. Take step number 1. We calculate 30% of 364,000, and we are going to get 109,200. But remember, we are not collecting 109,200. We are giving 5% discount on that 109,200. What does that mean? It takes us to step number 2. Step number 2, we find 5% of 109,200. But remember, the 5% is discount. So we are going to take it off. We are going to remove it. We are going to take it away. What does that mean? It therefore means we are going to have our 109,200 minus 5,460, and it's going to give us 103,740. Very important. But we can do this in one simple and smooth step. This way, the alternative step. We can just say 109 times 95%. Remember, we want to collect what percentage? If we are giving a discount of 5%, it means we are going to collect 100 minus 5. We are going to collect 95%. So we can just say times 95%, and then we are going to get 103,740. So this is the figure that we are going to take as the collection in December, for December, which is the collection in the month of sale. Remember, when it comes to January, we are going to take the 45% now. That is the figure that I've given to you in red now. Remember, it's straightforward now, because always you still remember your 30, your 45, your 22, your 30, your 45, your 22. So for January collection, When we are collecting for December, we are collecting the second collection, which is 45%, and we are getting 245,700. Straightforward. And then let's finish it off. We want now to collect in January, for January. Remember, that's the first collection. That's our 30% that we are collecting, right? But remember, this first collection always comes with a 5% discount. So we calculate 352,800 times 30%, and we got 105,840. We remember 5% discount must be taken off from this figure because that's what they've got to pay. So we are going to say times 5%. Here it should have been times 95%. 95% for us to get the final figure. Good. Now, let's continue and see some other questions that are coming from this information. Now, check here. We had our sales and our cost of sales. And because we were busy doing the debtors collection schedule, let me take you into the cash budget now. Where are we going to get or take that information to? So check from our debtors collection schedule, we ended up having these two very important amounts. So the collection for December is going to be 315,140. And the collection for January is going to be 416,472. So these figures are going to be taken into the cash budget. We start with the December amount. It replaces this question mark, which is red. And then the January amount replaces this question mark, which is also given in red. So in other words, after completing our debtors collection schedule, let's remember this information is a building block for the completion of our cash budget. So from the debtors collection schedule, we take it into the cash budget. But remember also, we are given the total sales for November. And here we need what? Cash sales. That's where we remember what they said. They said 40% of the sales are on credit. And we said 60% of the sales are cash. So we can easily fill in the cash sales amounts into the cash budget. Very easy to do. The figures transferred into the cash budget, now done and dusted. Now let's deal with the cash part now. So what is it that we need to do? For us to find the figures for cash sales, we are just looking for the 60% because we know 40% is on credit and 60% is cash. So it is going to appear in our cash budget just in a simple way. Take the calculations. For the month of November, we are taking 798,000 total sales. And then we are finding 60% of that. And there we are. These are our cash sales for the month of November. We get to December. We are taking 910,000. And we are just finding 60% of that. There we are. These are the cash sales for the month of December. And then we go to January, we are taking 882,000 and finding 60% of that. Please check. We have got our 529,200. Then when we are having these cash sales figures, check how they are going to appear in our cash budget. These are our cash sales figures. The 60% is dictated by the question. Please take note. Life is good. One day you are just going to be given any one of those as missing figures and you are expected to calculate. This is how we go about it. Now, let's move on and look into the activity now that is giving us missing items from the cash budget, and we are expected to find those missing items. So they are saying here we are having an extract from the cash budget. So you can see A, it's our rent income for the month of November that is missing. B, it's our payment to creditors for the month of January. And C, it is our cleaning services fee for the month of January. These are the three A, B, and C missing figures which we are expected to calculate. Now, apart from this information that we are given in the extract from the cash budget, we need additional information. What are they saying about A? So they are saying rent income will increase by 9% per annum starting in January. So what is this saying? It is simply saying in December, it was before the increase. In January, it was after an increase of 9%. So what can we say? It means my January percentage, it's 109%. My December income should have been 100%. So we are looking for December before the increase. And we are given January after the increase. Simple proportion comes into play. 20,000 and 56 rands, we multiply by 100 over 109. Remember, what we are looking for, the unknown, goes on top. The unknown is the numerator, the 100% that's what we're looking for. Straightforward. We have been doing this, guys, since the start of the year. I don't think we are going to struggle much with this. Life goes on. Let's move on and check the next part. The next part, we have got to now find our B. Now, according to the information that we are given, it's saying B, it's payments to creditors. So the payments to creditors for the month of December is given, but for the month of January, it's not given. But they must give us additional information. Remember, we have got our information on sales and cost of sales there, right? And remember what I said to you last time. Our cost of sales are our purchases. Our cost of sales represents our purchases. So we are given the purchases in a way, in the form of cost of sales. And then they gave us additional information here with regards to purchases as well as payments to creditors. They're saying 80% of the stock is purchased on credit. So it means when we want to find credit purchases, we are just looking at 80% of these figures. That's how we are going to find our credit purchases. 80% of the cost of sales, because our cost of sales is our purchases. I can simply even replace my cost of sales and simply write purchases. When dealing with this topic, remember, cost of sales is equal to purchases. And then they said also, stock sold is replaced in the month of sale. They are simply saying there is a direct relationship between sales and cost of sales, sales and purchases. And then lastly, creditors are paid 2 months after the month of purchase. Please take note of this, which therefore means if a purchase is done in November, the payment is not going to come in December, but only comes in January. So when we go back to B, it is saying we want payments to creditors in the month of January. So if we want to know how much was paid in January, we are not looking at the purchases of December because it's done only 2 months after. So we are looking at the purchases for November. That's the reason why you can see here, there is something missing here. The purchases for December are not here. We don't need them. We need the purchases for November because whatever was purchased in November is being paid in January. Great. Is there any discount involved? No. So if we find the credit purchases for the month of November, we know that is the amount that we are paying in January. Let's do it. What are we waiting for? There it is. 456,000. Where is it coming from? Purchases for the month of November. But we pay only credit ones. So 80% of that are the credit purchases. We pay that in January. So that's where we get to our answer. That's great. I know you are following and we are still together. Our WhatsApp interactive number is still there, 064 748 8913. If you want to say something, if you want a comment, a view, just given to us. Now, let's move on so that we can see if we can be able to find figure C, cleaning services for the month of January. Now, according to the information given, it says, Shepstone Traders undertake special and extensive cleaning and sanitation during December each year. This has the effect of increasing the cleaning services budget by 65% in December only. So it means our December cleaning services expense is very high. Why? Because there is this activity that we always undertake in December only. So what is the December budget? It is 15,510. Is this normal? No. This is more than normal by 65%. So can we be able to find the normal budget? Yes. The normal is 100%. Remember that, right? Okay. Let's continue and read this statement to the end. The normal monthly fee is expected to increase by 5% in January. Okay, so it therefore means we can go back to the normal, but in January we are not paying the normal one. We are going to have that normal increased by 5%. Is this doable? I think it is. We start by finding the 100%, which is the normal. And then we increase that normal by 5%. And that becomes the payment in January. So it's going to look like 15,510 times 100 over 165. Why are we doing that? We want to go back to normal. Okay? After having the normal, we increase it by 5%. So we multiply by 105 over 100. Why are we doing that? To increase it by 5%. So this is to take it back to normal, and this is to increase it by 5%. Hope you are following. Hope it is making sense to you. Remember, back to normal. How do we take it to normal? Times 100 over 165. And then we increase that by 5%. And this is our result. Right? Let's continue. Now, you can see now when these amounts are now taken into, remember now, this was our missing A, which is rent income for the month of December. This was our missing B, and this was our missing C. So we are done in calculating the amounts that are missing in A, B, and C. Now, let's move on to another part of the same question, but this time there's going to be an analysis of some point. They're saying here, Brian is concerned about the workload of his staff. He plans to reduce the sales staff by 1 person. And then the other sales staff members are not happy with this plan. Okay. Information for November. So they're saying here, according to this, The number of sales employees, including the driver, is 5. So it means there are 4 on the shop floor, 5 the driver, and then that's the sales team. The number of repair employees, 2. Now, let's look into, so in other words, they are saying he intends to reduce the sales staff by 1. So it means they are going to be 4, including the driver. Okay. Now, let's check into the number of customers in sales. We had budgeted to achieve 230 customers, but we only got 175 customers. So it means we are not having the desired number of customers. What it means is, if we divide 5 into 230, it can give us roughly the number of customers we expect every sales rep to save. But are we achieving that? No. They are saving far less than what they should have saved. So is the owner justified for taking 1 off? I'm not saying anything. Number of repair customers. The repair customers now, we are budgeting to have 70 customers, which means what? It means each of the repair employees must save about 35 customers. But in actual effect, what's happening? We are getting 136 customers, far more than the budgeted. What does that mean? It means 1 repair technician or employee is going to end up saving nearly 70 customers, nearly double what they should have been saving. The other sales staff members are not happy with the plan. Okay, so the repairs employees, I think they should be the one not happy here. Anyway, let's check the information first. In accounting, when you understand the information presented to you, the job is half done. So understand the information. Total sales. We are budgeting to have sales about 798,000. Are we achieving our budget? No. Our sales are only 707. What does that mean? It means the guys in sales are failing to attain the targets. And because of that, whatever we are paying them for, they are not really doing it. Are we justified for taking 1 off? I'm not saying anything, but please take note. Now let's look into the salaries for the sales staff. We had budgeted to pay them 82,000 and we actually paid them 82,000. So we are not paying them 1 rand short. But are they achieving what they should be achieving? Food for thought. Now, let's go back again to the opening statement. Brian is concerned about the workload of his staff. He plans to reduce the sales staff by 1 person. The other staff members are not happy with this plan. Now, what is the question asking us to do? Provide 2 points that Brian can explain to his sales staff to justify his plan. Oh, yes. What can he say to his sales staff? I think if I was the owner, I already have got answers. Are you seeing the answers there? I guess you are. The class of 2022. Check here. Are they saving the number of customers that they should be saving? Definitely not. Are they achieving the amount of sales that they should be achieving? Definitely no. So what are the 2 points that we can use? This is one thing that you can say. The budget is for 230 customers and only 170 customers were recorded, 55 less. So what does that mean? It means there are some sales staff members who are left redundant because they have got no customers to serve. So I think the owner is justified for taking one off. Now, we can talk in terms of sales. Sales were less than the budgeted. We had budgeted 798. We only achieved 707. That is 91,000 less. It means when we have got less sales, it means they are having also to do less work. So why keep them when they are not doing what they should have been doing? I think the owner is justified for taking one off. Let's look into their salaries. They are earning a basic of 16,400 per worker. That is if we divide this by 5. 5 sales employees, including the driver, we divide it into 84,000, which we are paying them per month. Then it means one person is getting 16,400. Have they been paid a cent less because they have not achieved the required amount of sales? No. So what does that mean? The only way the owner can save is to take one off. So it means less people to pay because they are doing less. And then that is assuming the 5 are working, including the driver. But also, we can even say each worker is expected also to attend about 46 customers. You still remember how we got 46, right? 230 divided by 5, that's roughly 46. But the actual average they are attending is 35 because we are having that less. Because of that, we need to make sure that one of the sales staff members goes off our salaries structure so that we can be able to pay and save. So 2 points only. So your points should come from looking into, are they saving the number of customers that they should be saving all? Are they achieving the amount of sales? Because when sales are less than the standard or the budgeted, it means they are doing less work. And because of that, they are being redundant for some time. And the owner will be justified for just taking some of the employees off. And then let's look into the next part. Now, still looking into the same information where we have got the number of employees as 5 and then 2 for repairs. Now, they are saying here, explain why the repair staff member were not satisfied with their workload. Now, we are no longer interested in the sales staff, guys. We are now interested in the repair staff. How many are they? 2. Right. The number of customers, they are budgeted to see only 70 customers, which translates to 35 per staff member. But how many customers are coming? Actually, 136 customers came. What it means their workload increased. It nearly doubled. Oh, so what does that mean? Let's check what happened to their salaries now. They are budgeted to be paid how much? 11,000. And how much is it that they were paid? 11,000. These guys, they were never given even time to rest. They worked overtime and on overdrive all the time, and to be paid the same amount of salary. Do they deserve to be unhappy? Yes, I think they are justified for being unhappy. Explain why the repair staff members are not satisfied with their workload. Court figures. We have got everything to court. Now let's check. What are we going to say? They are overworked. Customers, they are too much. From 70 budgeted to actually 136. That's an increase of about 66 more than expected. That's a 94% increase. So customers prefer to repair rather than buy. So it therefore means, we would rather decrease the sales staff because people are not buying, and increase the repair staff. Why? Because people are preferring to repair than buying. Hard times calls for hard measures. Now, they are also expected to attend to 35 customers per worker, but they attended to about 68 customers, an additional of about 33. Oh, too much. Going to work expecting to save only 35, ending up saving 33 more than. So it means it's nearly double. But now, let's also check the fee income. The income that we are getting from these is doubling. It's going nearly double. The fee income was budgeted at 34,000, but we actually got 66. So if their fee income is going more than double, why are we still paying them 11,000 per month for both of them? So it therefore means they are getting a fixed rate per week, 5,500. They should be getting more when their fee income increases, when they see more customers. So I think it is being unfair to them in all respects. But remember, this is accounting. When you are telling us or explaining to us the reasons why they should not be satisfied, please remember, I beg you, to include figures, to include calculations, to include some figures that are going to tell us that you understood the information that is given to you, or at least you have seen the information that is being presented to you. We work with figures. Figures says it all for us. Without the figures, we are going to do as if we have not seen your explanation. Now, the last thing, what suggestion can you offer to solve the problem of work overload of employees? Oh, this was just a control question. If workers are being overloaded, what advice can you give to solve their problems? So these are some of the advice. One thing that you need to do is to train the sales staff members to do repairs, so that when there's more work on sales, they attend to their customers, but when there's more work on repairs, they join the repair staff. In this case, we are not going to have some being overloaded with work while these others are redundant and not doing anything. Suggest incentive bonuses or what we can call overtime pay. You know, there is no worker who is going to have a problem with being overworked and being overpaid. Overwork and overpay going in the same direction. They will be more than happy to overwork. Negotiate a better package. It may be a package that includes a basic salary and a commission, so that if I do more than what I should have done, then I am going to go to the bank smiling because of an increased salary or wage. Now, train staff to work in other departments on a rotational basis. Don't have employees who are only sales and only repairs. Because when there is more work on repairs, it means only these two are suffering. So we would rather have employees who can do everything, and then we can be in a position to rotate them and sometimes move one employee or two employees to where there's pressure. Workers to work in all departments. And then employ temporary staff members, all casual employees, or maybe employ more workers when there is more work. Find a way. This is what was expected of us. Now, we are still looking into this same information, but still going through analysis questions. Now, some of the information have been removed and others added so that we can be able to deal with the question that we are dealing with. So let's look into the information that we have. The number of customers, we can see the number of customers. We budgeted 230, we only achieved 175. Total sales, check that. 798,000 achieved. Budgeted, but the actual achieved is 707,000. Cash sales, check what happened to cash sales. Went down. Credit sales went up. But even though there was that movement, the total sales went down. Anyway, it says here, comment on the cash and the credit sales figures for November 2021. Explain why Brian is concerned. Court figures. So please let's look at this information. We are looking into cash and not cash or cash and. So we are going to comment on these two independently. So we are going to say cash sales. What happened to cash sales? Increased. You can say increased from, cash sales decreased, from 478,800 to 148,000. Or you can just find the difference and say cash sales decreased by. Oh, that is if you can be able to do that. Now we move on to credit sales. Credit sales increased from 319,200 to 565,000. Now, why would this be concerning to the owner? Why is Brian worried about this? When there is an increase in credit sales and a decrease in cash sales, does it affect your cash? Yes. Because remember, credit sales is give me the goods now and leave you with no cash. I will pay later. Now, we had budgeted to receive more cash sales and less credit sales, which means we had budgeted to receive more of our cash now than later. And this is not taking place. It is concerning really to Brian. So what are we expected to do? Comment on the cash and credit sales and explain, okay? The cash sales were lower than expected by 336,800. Or you can make it a percentage by about 70.3%. Or you can say it is from to. Very important. But you are also going to mention credit sales which are higher than expected by about 245,000. That is about 77%. Or you can just tell us from this to this. Very important. Now, why is it concerning? Cash sales are now 20% of the total sales. We were expecting cash sales to be 60% of the total sales, but only 20%. While credit sales are now 80%, but we're expecting credit sales to be only 40%. That is very concerning. very important. Now, let's look on to another part. Now, this time we are looking into variances. Remember, what are variances? Differences that are there between the actual and the budgeted figures. So we are given these 4 items: sales, fee income, fuel for leased delivery vehicle, and consumable stores for repairs. Now, when it comes to this, one thing that you need to know is this variance to our benefit? Is it positive or is it negative? Now, let's look into sales. We had budgeted 798,000 sales, but we are actually only getting 7 or 7,000. What does that mean? It means now we are losing out on sales. We are not achieving our targeted sales by 91,000. That's a negative variance. Let's go to fee income. Fee income increased. It's more than double. Increased by 34,000. Is that going to make us smile? Yes, definitely. We have got to smile when it comes to fee income. Why? Because it went up. It doubled. That's a positive variance. Fuel on leased delivery vehicle. We had budgeted fuel for 20,800, but we are actually spending 19,900. Is that a good thing? Yes, we are spending less, which is good, but we'll look into other dynamics. And then consumable stores for repairs. We had budgeted 8,000. We are actually spending 12,100 on consumables. Now, there's one other thing that I want you to check here. The relationship between these variables. So there are 2 which are directly related, and the other 2 also related. Now, let's look into sales. What is related to sales? It's fuel for delivery. Because what are we delivering? We are delivering goods that have been sold. So let's look into that. We are saying to deliver goods to the value of 798,000, we needed fuel for 20,800. And then, have we managed to deliver the same amount of goods? No. Our sales went down by 91,000. But do we have an equal decrease, a proportional decrease in fuel? Fuel only decreased by 900. When our sales decreased by 91,000, fuel only went down. Is that a cause for concern? Food for thought. Now let's move on to fee income. Fee income, remember, it is income coming from repairs. And we are using our consumable stores to repair. So what does that mean now? We had budgeted to say, after using 8,000 of our consumables, we are going to get a fee income of 32,000. 8,000 contributing towards 32,000. But what happened? Our consumable stores increased, but they never doubled, guys. They increased from 8 to 12, which is an increase of 4,100, right? But what happened to our fee income? It went up, double, plus. So it went to 66,000, which is an increase of more than double. So it means the cost is not doubling, but the income is. Just look at it that way, guys. It might not be the accounting way of looking at things, but that's what we need. So when they are saying comment now, Because we are going to comment on whether we have managed to control our fuel. Is the answer going to be yes or no? They're also going to ask us to say, have we managed to control our consumable stores? Is the answer yes or no? The comparison now depends on the other variable that is linked to that. So when we are looking at fuel, it's not only fuel that we have decreased by 900 that matters, but fuel in relation to sales. When we're looking into consumable stores, we are not just looking into the increase from 8,000 to 12,000 only. No, we are saying in relation to the fee income that is coming from that. Okay, now what are they saying we should do? Comment on the control over fuel for the delivery vehicle and consumable stores used. So we are commenting on fuel and consumable stores. And please check here, they said and. They didn't say or. They said and. It means we are going to compare or comment on both. We quote figures in our explanations. So let's look into fuel for delivery vehicle. Please take note. Fuel, you must tell us that it is not well controlled, guys. It is not well controlled. Now, assuming that all the customers that are coming are requesting for delivery, we had budgeted 2.6% of the sales being for fuel. Because if you find 2.6% or you take 20,800 over 798, the budgeted right, times 100, you are going to get 2.6%. But actually, what percentage are we using? We are using 2.8%. We budgeted, we are getting that. So that is not on. So if you check, we can also mention that the total sales, they decreased by about 11.4%, sorry. That is 91% decrease. But when it comes to fuel, it only decreased by 4.3%. So these things are related, and because they are related, they should be going down or going up in the same proportion. So if sales decrease by 10%, we expect fuel to decrease by 10%. If sales increase by 10%, we expect the fuel to increase by 10%. Failure means we are not controlling it well. Hope you are seeing that. Now, we are now going to look into the last one, and then when we get there, I'm going to give you 2 minutes break so that at least you can be in a position to reflect on this before we get on to the second part of the question. So let's look into consumable stores for repairs. Now, please take note, when it comes to consumable stores, there was an increase, of course, in consumable stores from 8,000 to 14,100, but that was not as the increase in the income that we are deriving from that. So we can safely say there is efficient control over consumable stores. We can say they are being well controlled. Or we can say there is no wastage, or there is a minimal wastage of our consumable stores. Why are we saying that? We had budgeted to spend 25% of fee income. Because if we say 8 over 32,000, that is the budgeted. That's about 25%. But when it comes to actual, we are spending 18.3%, which is less. Oh, guys, we are not wasting anything. We are achieving. We are the best. And then let's also move on to fee income. Fee income is more than the budgeted by 106%. So it means it went double. 100% is double. So it means it went even more than double from our budgeted of 32 to 66%. But the consumable stores that, the consumable stores that we are using to get this income, it went up by only 51%, not, so it therefore means it's increasing slower than the increase in income. Guys, when income is increasing more than our expenses, we are happy. It means we are controlling our consumable stores for repairs better because we are getting more income. Now, your 2 minutes start now. Just reflect for 2 minutes. We are coming back and looking into our second activity. Welcome back. I was just enjoying a chat with one of my other students here. She was asking to say now, in the first question that we did, we are given total sales and total cost of sales. Now, where are the credit coming from? Remember what the question said. It was saying there's a percentage for cash and there's a percentage for credit. And they specifically said 40% of the sales are credit. What does that mean? 60% is cash. So you use the cash one, the total, and find 40% of the total, then you can be in a position to find your credit, which goes into our debtors collection schedule. Let's continue to interact, guys. 064 748 8913. Now, let's move on to the second part. Projected income statement. I'm giving you the format, guys. Remember, a projected income statement is still an income statement. Only that we are projecting now. We are looking into the future. There it is. Nothing has changed. Sales, cost of sales, gross profit, among other things. And then it goes on other expenses until we can be in a position to find our operating profit. We add interest income, we subtract interest expenses to find the net profit for the year. This is a basic income statement that we are always going to find. Now, when it's complete, it looks like this. I'm not going to spend time on this, guys. We have been looking in the income statement and we know what it looks like now. Very important. You always get profit at the end of each and every month. In this case, this is 15,345 in July, 15,130 in August, and 14,730 in September. Now, let's look into activity number 2. The financial year end for Carpets Galore Private Limited is 31 October 2019. Thembi Tsomi is the sole shareholder and director. Now, indicate amount in the appropriate blocks for the cash budget and the projected income statement for the 3 months ending January. So we are given 3 statements here, guys. And they are saying here, this information can either be entering into the cash budget only, into the projected income statement only, or into both. Now, let's see if we know how we are going to be entering this. So we are going to start with the transaction number 1. A printer costing 40,800 will be bought for cash 30 November. So it means the cash is going to be paid in November. Very important. Depreciation is going to be 680 per month. Where is it going to be recorded? Let's deal with the figure that we are going to pay in November. Is cash moving? Yes, it goes to the cash budget. No problem about that, right? But is that 40,800 going to affect our projected income statement? The question is the 40,800 an income or is it an expense? It's not income, it's not an expense, so it's not going to affect our projected income statement. But there is also depreciation coming. Is depreciation going to affect our cash budget? Never. It's a non-cash item. Is it going to affect our projected income statement? The question is it an income item or is it an expense item? And the answer, it is an expense item. Because of that, it affects our projected income statement. But now, where is the amount going to appear in the cash budget? Only in November, because the payment was done on 30 November. Was the payment done in December again? No. Was it done in January? No. But when it comes to the depreciation, where is it going to appear? It is going to, remember the asset was bought on 30 November. So it means it was never used in November. So it means the expense starts in December, January going forward. Straightforward. Let's move on to the next one. Transaction number 2. We are doing the same thing. Now, this one, it's saying, on 1 January 2020, 48,000 will be paid for a 12-month insurance contract. It's a contract. Are we paying any money? Yes. How much? 48,000. When? On 1 January. So it means 48,000 must appear in the cash budget on 1 January. In January. So it means there is no insurance paid in November. There is no insurance paid in December. There is no insurance, there is only insurance paid in January. And how much? 48,000. We record the cash. But now, is the 48,000 the expense all for January? No, it is for 12 months. So it means this now, as an expense, it's now going to be spread. So remember, when you get to the projected income statement, we are only recording income and expenses. Let's spread it. We divide 48,000 by 12. We get 4,000. So it means the expense for January, 4,000. February, 4,000 going forward. The payment is 48,000, but the expense is 4,000 for January. And then we go to transaction number 3. This is about a loan. What are they saying here? They're saying a loan of 100,000 will be received from Viva Bank. This will be repaid in 20 equal installments starting in January. And then there's also an issue of interest. Let's deal with the amount received. Remember, when a loan is taken, we are receiving cash. The minute we are receiving cash, it means we are affecting our cash budget. So is our cash budget going to be affected? Yes. When? In December, when we receive the amount of the loan. And how much? 100,000. This is the recording of the loan. Now, is a loan going to affect our projected income statement? The question is a loan income or an expense? No. A loan is a liability, so it cannot affect the projected income statement. So we are not recording anything here. Done with the loan amount. Now let's look into the loan repayment part. When we are going to be repaying the loan, are we going to be using cash? Yes, so it's a cash item. And if we are paying 100,000 in 20 months, it means we are dividing it by 20 and we are getting 5,000. So it means per month, how much are we paying? 5,000 every month. Starting when? January. So there's no payment in November, no payment in December. We start paying in January. But is a loan repayment an expense? No, it's not. So it means it is going to affect our cash budget, but it's not going to affect our projected income statement. Good. Interest is going to be paid at 12% per annum, and it's not capitalized. When they're saying it's not capitalized, they're saying it's not going to be added onto the loan, but it is going to be paid every month as it is being calculated. Which therefore means we are going to start calculating our interest and paying it in the month of January. So we find 12% of 100,000 times 1 over 12, because we want to find interest for 1 month. And the answer is 1,000. So we are going to pay interest of 100,000 in January. I mean of 1,000, sorry, in January. But is interest an expense? Yes. So because interest is an expense, it affects our projected income statement as an expense. Which month? January. Very important. So you need to be able to know the distinction or the difference between these two statements. Otherwise, you wouldn't be able to get it right. Now, let's move on to what it is going to look like at the end. This is the answer. The printer, only in the cash budget, the amount for purchasing it, and then depreciation goes to the projected income statement. Insurance, we are going to say the amount paid appearing in the cash budget and the income or the expense for the month being the amount for every month going forward. This is how it appears, and it's straightforward. Now, let's look into the next question now. This, we are now expected to interpret a debtors collection schedule. Check this one, it's done, prepared for us, straightforward. But they are now going to ask us questions about it. But let's see if we understand something here. When it comes to November collections, we are collecting for 2 months. Which months are they? We are collecting for September, collection number 1. We are collecting for August, collection number 2. So this is collection number 1, this is collection number 2. When it comes to the collections in December, this is collection number 1, this is collection number 2. When it comes to January, this is collection number 1, this is collection number 2. Very important. So what does that mean? It means every month we are collecting twice. In November, we are collecting for September and August. In December, we are collecting for October and September. In January, we are collecting for November and October. Now, this is the total collected for December and the total collected for January. Now, let's check. What are they expecting us to do with this information? So they are asking us to say, Thembi is preparing projections for the period commencing in November. Thembi does not grant any discounts for early payments. So what do Tembi wants us to do here? They're saying calculate the percentage of debtors who settle the account in the second month. And remember, the second month is always, remember when we are in October, we are in September, right? September is the first month, followed by October, followed by November. So it therefore means this becomes the second month, because from September, this becomes the second month. This becomes the second month. This becomes the second month. So we can use any of those months to be able to do it. If we decide to use January, we are taking the 90,000 over the 120, and then we multiply by 100 to find the percentage that we need. So you can see it's going to be like this. It's either we use 67,500 times over 90, or we use 75 over 100, or we can use 90 over 120. Whichever one we want to use, the answer will always be 75%. Are we together there? Those who are paying in the second month. So it means our thing is a person buys in November. The person is not paying in the first month, is not paying in the second month. In November, in December, it's only paying in January, which is the second month. So it's skipping a month in between. Not paying in the month of sale, not paying in the first month after sale, only paying in the second month after sale. Good. Now, they also wanted us to calculate the percentage of debtors that are going to be written off. Now, what are they saying here? If you check, we are having September, for example. Let's go to September. How much are the credit sales for September? It's 90,000. Can you see that? And then in November, we are going to receive 67,500. And in December, we are going to receive 19,800. But is this going to add to the total of 90,000? No. It therefore means there is something that we are never going to get from our 90,000. So we can safely say 90,000 minus 67,500 minus 19,800, we are going to get 2,700, which is an amount that we are never going to get back. That's bad debts. So to find now the percentage of bad debts, it's going to be 2,700 divided by the 90,000, which is the total of our debtors for that month. And then you divide by 90 to get, and then you multiply by 100 to make it a percentage. And you can see the answer is 3%. Check here. 90,000 are the credit sales for September. In November, we expect to receive 67,500. In December, we expect to receive 19,800. So if we subtract those two amounts, we are going to remain with 2,700 unaccounted for. That's your bad debts. What percentage is that? 3%. Let's move on. Next, they are saying here, refer to this information, and let's look into this information now for September and October. Directors' fees. For September, we had budgeted 50, we spent 50, no problem. In October, we had budgeted 50, but we are actually paying them 40,000. So we are paying them less, these directors. We don't play with them. So we are paying them 10,000 less than what we had budgeted. So it means we are now starting to save money somewhere there. Let's check with the office workers. In September, we had budgeted 9.2 and we paid them 9.2, no problem. But in October, we had budgeted 9.2, we are paying them 11,040, which means we are paying them more. It means they got an increase in salary there. These are the office workers. So they should be celebrating, I think. An increase in salary is a good thing, guys. You'll see one day. Sales of the salesperson, sorry. We had budgeted 20 in September and we spent 20,000. So fair and fine. We had budgeted 20,000 in October, but we are not paying any salary anymore to the salesperson. Why? We are introducing commission. Do you know the difference between a salary and a commission? Salary, you get paid at the end of the month. Commission, it is related to the input. So you work more, you get more. So in this case, they are paid by commission because they brought more work to the business. Okay, but it only started in October, actually. Training of sales staff. In September, we had budgeted to train them for 15,000, but we never did any training. In October, we had budgeted another 15,000, but what happened? We ended up spending 40,000 on staff training. This information is very important if we are ever going to be able to answer questions given. Now, let's go to the questions and see what are they saying here. They're saying office workers are unhappy with the increase that Thembi gave them on 1 October 2019. Explain what she should say to them. Provide 2 points and quote figures or calculations. Let's check here. These are the office workers. In October, they even have been paid more than budgeted. If we can check, we can even find what is the percentage increase. We say 11,040 minus 9,000. I'm seeing something like 3,000 point something. So 2 point something. So it means now they are getting a salary increase. Why are they not happy? Let's see what they. I think these guys are not being grateful. They got a salary increase. That's 1 point. Point number 2, the directors, they got a salary cut. We never paid them the fees of 50,000 that we had budgeted for. We even paid them less. You can't be grateful when even your neighbor is getting less, when now you are even getting increase. And check here, they are being trained. You know the advantage of being trained? It means you are being upskilled and you can use this for later. When you become jobless, you will raise your certificate and say, hey, I can be employed. And sometimes you can even use it as a negotiating tool in future to say, I am not the boy that you employed last time who had no qualification. Check, I've been trained. So these guys, I think they don't have a reason for being ungrateful and for being like this. So what can be our reasons here? They received an increase of 20%. It's even far more than in the inflation rate. So they must be grateful. What else? They received training which cost 40,000, even 25,000 more than they budgeted. This will benefit them in future. So why are they complaining? And please take note also, the directors took a 10,000 drop in their pay. It means they got a salary cut. So if you got an increase when someone is getting a salary cut, you should be grateful. That's what we are going to be telling to these guys. And then let's move on to this one now. It's giving us packing materials and delivery and installation and installment of carpet. What are they saying here? They're saying Thembi pays his son Jacob to deliver and install carpets to customers. She budgets 280 per square meter for this. Comment on the control of this expense. So we are interested in this expense. Now, let's check. In September, we had budgeted 14,000 and we paid how much? 14,000. Now, when it comes to October, we paid. But what is happening? We are paying more than budgeted. So can we say we are okay with what happened in September? I don't think so. Because if you check 2,500, that's the packing materials that we were expecting to use, right? And it's 280. But we used less. So it means we never did what we were expected to do. We never installed as much when it comes to carpets than we were expected to. So we shouldn't pay 14,000 when we are not doing the job that gets us 14,000. But when it comes to October, there was an increase in packing material use. So it means we did more work than we actually budgeted. And there was also an increase in the amount, but is it proportional? That's what we are checking here. So let's check what is it that we are expected to be having here now. So you check on the workings. Budgeted 5,000 at 2.8, which is 14,000. Because if you divide 2.8 into 14, you get 5,000. But actually, what happened? It was less. So we should have been expecting 2.8 by 3.8, which means we are expecting to pay them 10,640. But how much was he actually paid? 14,000. Let's go to October. We had budgeted 14, but actually it's 6,280, which is 16,800. So at least in October, it's better because it was paid correctly. But in September, we overpaid the boy. Maybe because he is the owner's son. Now, this is all that we had time for today. I hope and I wish you got something out of this lesson. Please, you are thanked for watching this lesson. Remember just to sanitize, to wear your mask, to always maintain your social distance. I am your partner in accounting, and we are going to be meeting again in future lessons. Until then, enjoy. Thank you so much for today.